Banks play a huge role in our lives, but have you ever wondered how they actually make money? And more importantly, how can you benefit from it? Let's break it down in a simple, easy-to-understand way. First off, what exactly is a bank? Think of a bank as a place where you can safely store your money, but it's also where you can borrow money when you need it. Banks help manage your finances and make sure that your money is working for you. The concept of banking dates back thousands of years. The earliest known banks were in ancient Mesopotamia, where temples and palaces provided safe places for people to store their grain and other valuables. These early banks also provided loans to farmers and traders. Fast forward to the 14th century in Italy, where modern banking began to take shape. The Medici family in Florence established one of the most famous early banks, which handled transactions for merchants and royalty across Europe. They introduced innovations like double-entry bookkeeping, which made it easier to track finances accurately. In the 17th century, the Bank of England was founded, and it became the model for modern central banks. Central banks play a crucial role in the economy by controlling the money supply and interest rates. For example, the Federal Reserve in the United States, also referred to as the Fed, was established in 1913. The Fed's main job is to manage inflation and promote employment by setting interest rates and regulating banks. During the Great Depression in the 1930s, many banks failed because they didn't have enough money to cover withdrawals. This led to the creation of the Federal Deposit Insurance Corporation, FDIC, in the United States, which insures deposits up to a certain amount, giving people confidence that their money is safe in the bank. Now, let's talk about the digital age. In recent years, banking has undergone a significant transformation thanks to technology. Online banking and mobile apps have made it easier than ever to manage your money. You can check your balance, transfer funds, and even deposit checks from your smartphone. Digital banks, also known as neobanks, operate entirely online without physical branches, offering lower fees and higher interest rates. Now, how do banks make money? The main way is through interest. When you deposit money into your bank account, the bank doesn't just keep it sitting in a vault. They use it to give out loans to other people or businesses. Here's how it works. Let's say you deposit $1,000 into your savings account, and the bank pays you an interest rate of 1% per year. At the end of the year, you have $1,010. Now, the bank takes your $1,000 and loans it out to someone else at a higher interest rate, say 5%. That person will pay back $1,050 at the end of the year. The bank makes money from the difference between what they pay you, 1%, and what they charge the borrower, 5%. This difference is called the net interest margin. To give you an idea, in 2020, the average net interest margin for US banks was about 2.8%. That might not sound like a lot, but when you're dealing with millions or even billions of dollars, it adds up to huge profits. Another way banks make money is through fees. Yep, those pesky fees we all hate. These can include account maintenance fees, overdraft fees, late payment fees, and transaction fees. For example, in 2019, US banks raked in over $11 billion just from overdraft fees. While these fees can be annoying, they are a significant source of income for banks. Now let's talk about investment banking. This is a bit different from your regular savings or checking account. Investment banks help companies raise money by issuing stocks and bonds. They also help with big deals like mergers and acquisitions. For instance, if Company A wants to buy Company B, an investment bank will help make the deal happen and earn a nice fee for their services. In 2020, the global investment banking industry made around $100 billion in fees. Banks also make money by investing in various financial instruments like government bonds, corporate bonds, and stocks. When banks invest in these, they earn returns, which add to their profits. For example, if a bank invests in government bonds with a 3% annual return, they make money from that investment. Plus, banks engage in trading activities, buying and selling financial instruments to make money from price changes. Now, how can you use all of this information to make sure that you're benefiting? Let's talk about a few ways. First, make sure you choose the right type of account for your needs. If you want to save money, look for a high-yield savings account. These accounts offer higher interest rates compared to regular savings accounts. For example, while a typical savings account might offer an interest rate of 0.05%, a high-yield savings account could offer 1% or more. Over time, that higher interest can really add up. Next, be mindful of fees. Always check the fine print when you open a new bank account. Look out for things like monthly maintenance fees, minimum balance requirements, and overdraft fees. Some banks offer accounts with no fees if you meet certain criteria, like setting up direct deposit or maintaining a minimum balance. Also, take advantage of credit cards with rewards programs. Many banks offer credit cards that give you cash back, travel points, or other rewards for every dollar you spend. If you pay off your balance in full each month, you can benefit from these rewards without paying interest. For example, if you spend $1,000 a month on a credit card that offers 1.5% cash back, you'll earn $180 a year in cash back. Just be sure to use credit cards responsibly to avoid debt and high interest charges. Another way to benefit from banks is to use their financial planning services. Many banks offer free or low-cost access to financial advisors who can help you with budgeting, investing, and planning for big financial goals like buying a house or saving for retirement. These experts can provide valuable advice and help you make the most of your money. Now let's talk about loans. Whether it's a mortgage for a house, a car loan, or a personal loan, banks can help you finance big purchases. To get the best deal, shop around and compare interest rates from different banks. Even a small difference in interest rates can save you thousands of dollars over the life of a loan. For example, on a $200,000 mortgage, the difference between a 3.5% interest rate and a 4% interest rate could save you over $20,000 in interest payments over 30 years. It's also worth mentioning online banks and credit unions. Online banks often have lower overhead costs compared to traditional brick-and-mortar banks, which means they can offer higher interest rates on savings accounts and lower fees. Credit unions, on the other hand, are not-for-profit institutions owned by their members. They often offer better rates and lower fees than traditional banks. For example, in 2020, the average interest rate on a 3-year car loan from a credit union was 2.87% compared to 4.74% from a traditional bank. Let's not forget about the power of compound interest. When you save money in an account that earns interest, you earn interest not only on your original deposit, but also on the interest that has already been added to your account. This can significantly increase your savings over time. For example, if you deposit $1,000 into an account with a 5% annual interest rate and leave it there for 10 years without adding any more money, you'll have $1,629 at the end of 10 years thanks to compound interest. I hope you found this video helpful or interesting. If you have, don't forget to like, comment, and subscribe for more videos like this.